Well, in this final video on capital structure, let's see if we can complete the question. The question here is, how can a company find its optimal capital structure? Now, the optimal capital structure can be figured out two ways. What is the way that minimizes weighted average cost of capital, and what is the way that maximizes stock price? Both questions yield the same answer, right? They give us the same result, which is the optimal capital structure that creates either minimizing cost of financing or maximizing the stock price. So in our previous video, we talked about a company that's thinking about recapitalizing. They have varying levels of debt. They have $2,000 total in assets. So we have a debt capital ratio. We talked about the equity to capital ratio, right? So we've calculated that. That gives us our probabilities, or not our weights for our weighted average cost of capital. We have calculated in the past our cost of equity at varying levels of debt, and we also can calculate our cost of financing after tax, of course, with the cost multiplied by 1 minus the tax rate. First thing we can do is we can calculate the weighted average cost of capital. If you do that, again, if you remember, it's just the weight, right? 0 times the cost of debt plus 100% times the cost of equity, 15%. That's our weighted average cost of capital at 0% debt. Going down the list, you will see, in this case, at $500,000, that is the level of debt that's going to give us the minimum weighted average cost of capital. So what else can we do? What other mechanism can we use? Well, now we can also look at the stock price, and if we assume a stock price with 0 growth, right? If all earnings are paid out as dividends, that means the earning growth rate is going to be 0. So earnings per share will equal dividends per share. So to find the expected stock price, again, we need to find the appropriate cost of equity at each one of the debt levels to find the price. So how do we go about doing that? So again, here's the amount of borrowing that we've done. Here are the dividends per share at those different levels. Here is the cost of equity. So again, if you take the dividend divided by the cost of equity, 0 debt, you end up with $25. If we do this for all 5 cases, again, you find that the maximum stock price in this case occurs at $500,000 of leverage. So the maximum earnings per share, $4.88 at $1 million, and the debt capital equal 50%. Remember that the dividends per share and the earnings per share are here because it's 100% payout. So the risk is too high when the dividend capitalization is at 50%, right? So what debt ratio maximizes earnings per share? Again, if we come back, we can go back and look, and we can see at what point it maximizes. The challenge, though, is at that point we also have a lot of risk. So price is maximized at $26.30. That's at a 25% debt capital ratio. Earnings per share is maximized at 50%. But remember, we're not interested, I don't want to say not interested, the question here is what happens to price if we change the debt structure, right? one of our original videos talked about the goal of financial managers. And the goal of financial managers is to maximize shareholder wealth, which is to maximize price. Profits are important, but they're not the most important thing to shareholders. So again, what this says is, you can make more profits, but that doesn't necessarily equate directly into increasing wealth of the owners. So what happens if we change the business risk, right? What if that somehow changes in our analysis, right? If there was more business risk, then the probability of financial distress would be greater, and the optimal capital structure would then be one that had even less debt. But lower business risk would lead to an optimal structure with more debt. So business risk, right, changing the operating functions of the company will have an impact on the cost of financing. So ultimately, it will have an impact on the debt structure that turns out to optimize the price. So how do these factors, the one we're looking at here, how do they affect the target capital structure, right? Sales stability, right? The more unstable the sales, the less likely you want to have a lot of debt. What about high operating leverage? Well, let's think about this. If you have a lot of operating leverage, right, there's a lot of business risk. There's chances that you won't be able to meet your operating income, which means there are chances you wouldn't be able to pay your financial risk either. So again, the higher the operating leverage, most likely the lower the amount of financing we would want. We can look at corporate taxes, personal taxes. What about bankruptcy costs? The greater the bankruptcy costs for a company, the less likely they want to borrow a lot of money. What about management spending money, right? And this is an agency cost that we've talked about in some previous videos. How flexible are they with financing? Are they locked in already? This is going to have an impact. If you need more funds to do anything, however, you're already locked in, let's just say with a maximum amount of debt that somebody will give you now, how do you expand? How do you grow? So Medigli and Miller have what they refer to as the irrelevance argument. And there are several things in how we want to kind of discuss this as we conclude our discussion. But the question is, what happens if the company, what happens to price when the company borrows more money? If you look across here we have our leverage and debt to capital ratio. The blue line here represents the outcome where we would say that the connection between debt and price is irrelevant. It doesn't affect price. The problem with that is that it really doesn't make much sense. It avoids several very important factors that we consider important in running a business. The two factors: number one, we're worried about taxes. Number two, we're worried about financial distress and the costs of bankruptcy. The red line here represents the changes in value when a company increases their debt structure, when we assume that there are taxes. And it really doesn't matter whether we have personal taxes or corporate taxes. There is an upward slope that basically says because of taxation, there is a benefit to the company for borrowing. Now the curvilinear function here represents what happens when we now include not just taxes, but we also incorporate financial distress. As the downside of borrowing increases, which only happens when you borrow more money, as that financial distress cost could possibly increase, it starts to eat away, if you will, at the benefit that you get from the taxes from the interest rate. So how does that fill into our plan? Well, eventually the financial distress costs will exceed the benefits that you get from borrowing and taxes. So that's why we get this curvilinear function. And here it essentially states that the optimal capital structure should be right here where we have D2 here, which represents the maximum point on this curve. That is a point, if we looked further at some data, where we most likely would find the maximum the maximum stock price, and we also could equate that then to the minimum weighted average cost of capital. So let's see if we go down through here and if we can kind of bring this to a conclusion, right? So this previous graph obviously shows the tax benefits and the bankruptcy cost theories, but it doesn't tell exactly the whole story, right? The main problem assumes that investors have the same information as managers. So in theory, that graph seems to hold. The challenge, though, is our investors don't have all the information that we have. So now we have to take into account how are they going to react with the amount of information that they have. So we have a theory called the signaling theory. And the signaling theory suggests that companies should use less debt than what Modigliani and Miller suggest. This is what they refer to as unused debt capacity, right? This is going to help us avoid stock sales, which depresses stock price because of these signaling effects. So let's see if we can talk about this in general. So what are the assumptions, right? Managers have better information about the company than outsiders, investors. Managers act in the best interest of stockholders. Let's think and ponder just for a second whether or not that is true or not. We definitely know that managers know more about the company than outsiders. Are we certain that our managers are always going to act in our best interests? Some of the research is mixed on that question. But if this is true, what can managers be expected to do about stocks, right? If managers think that the stock price is too high, it's overvalued, they might want to issue the stock. Of course, if it's undervalued, they might want to issue debt. So let's think about how this might work for us. So if you are an investor, when would you ever sell the stock? You would never sell a stock unless you were sure, or at least you felt sure, that the stock price was not going to go up. It was at its maximum peak. That is the only time you would want to sell. So let's put that in the context of managers and a corporation. When would they ever want to issue, in quotes, sell the company's stock? They would only sell the stock or issue stock if they felt that the stock price itself was overvalued. On the other hand, when would they ever buy back stock? They would only buy back stock when they felt that the stock price was at its low point. They would buy it low so that maybe later on they could reissue it at a higher price and get higher cash flows for the company. So as a result, right, investors typically view a stock offering as negative. Managers think the stock is overvalued, right? And again, managers should know more about what's going on in the company than anyone else. So in conclusion, right, we need to make some calculations, but we need to understand that there's some challenges with this. When we talked about the weighted average cost of capital, we talked about how not unstable the formula is, but how often the formula changes. Since it's based on the market value of stocks and bonds, it is constantly changing throughout the day. So getting some very precise numbers is very difficult to do. So in the end, we end up with capital structures that can change fairly widely, right? We know or can understand what our industry does. But as I mentioned a little bit further, I think in the end, a great deal of this, we obviously have to understand about taxes. That's important. We have to understand a little bit about operating risk and financial risk. We have to incorporate the ideas of financial distress. All those things are important. But in addition to that, there is this softer side. There's the more, what do investors think? How does that affect our decision? So that's the end of our video on capital structure. I'll talk to you soon.